like to extend my own welcome to everybody here today. To those who were with us last year, welcome back. And it's lovely to have any first-timers with us as well. There are really three things I just wanted to touch on today, just by way of an introduction. Firstly, I wanted to just give a recap on the investment principles that really form the foundation of everything that we do at Morningstar. I then want to talk a little bit about our research resources. As an organisation or investment management business, we're very focused on building investment solutions based on our proprietary research, and I wanted to just delve into the different flavours, if you like, that research actually takes. And then I wanted to finish off just by talking about our, as Peter said, our interest in investor behaviour and behavioural science, and just explain one of the reasons that we are so interested in this and in working with people in the room to achieve better investment outcomes for investors. You're going to hear a lot from Heather and from Regan later on about this area, but I just wanted to touch on that just by way of introduction. At last year's roadshow, I referenced Bill Miller, the chairman and the CIO of Legg Mason. He also ran the Legg Mason Global Value Fund for a number of years, and he was speaking at Columbia University to a security analyst class, and what he was saying to that class was, when you think about investing, you really need to think through quite carefully what your source of investing competitive advantage is. In other words, what is it that you can do differently to other investors that enable you to achieve greater or superior investment results? And he really distilled this quite neatly into three areas of competitive advantage. And the first one was an informational advantage, where as an investor you have access to information that not everybody else has. And that information actually gives you an advantage, and you're able to exploit that and achieve better investment results. Now, as we know in most countries, this is now called insider information, and it's illegal. So it's a great advantage for those who can get hold of it, but it's not particularly prevalent, and it's very difficult for that to be a durable source of competitive advantage. The second source that he spoke about was an analytical advantage, and this is the way that many investment organisations are structured. You're able to develop models or analyse securities or funds to develop specific insights on those securities that others may not have. And again, he argued that this one is it's more durable, it's more possible, if you like, than an informational advantage, so it's more readily available. But it's very, very difficult to always be the smartest guy in the room. And the third area that he called out is a behavioural advantage. And this is an advantage to investors that really comes about because of the manifest tendencies for large numbers of investors to behave in very, very predictable ways to certain situations. And this is the one that he believes, and as do we, is by far the most durable and sustainable. It's the advantage that has really distinguished the really great investors over time. They understand very well what they can do better, and they stick very religiously within their own circle of competence. And it's this behavioural advantage that the investment principles that we have as an organisation are really designed to help us exploit. We want to have very consistent decision-making. We want to have very consistent investment behaviours, irrespective of the market scenario that we find ourselves in. So these are the 7 investment principles that we have across Morningstar. I'm going to touch on each one of these just very briefly. And as I said, these are really there to guide, make sure that we have very disciplined and consistent investment decision-making. So we put investors first. Jack Bogle of the Vanguard Group, founder of the Vanguard Group, is widely quoted as talking about a fiduciary society. He's been talking about this for a number of years. And I think the concept of a fiduciary is it's a very simple one. In fact, a fiduciary is somebody who is, of course, placed in a position of trust with respect to the assets or property of somebody else. And I think accepting this notion of a fiduciary is one in which you have to actually accept that your investor or your member actually has the right to insist that their interests be placed ahead of the interests of your own company, of your own firm, or indeed of our own firm. And that's very, very difficult for most businesses to do. If you consider the structure of the investment management industry by and large, it's set up in such a way that most organisations are remunerated on the basis of asset growth. And of course, most investors are rewarded based on the investment performance that they receive. And what you tend to find is that as investment performance, or as assets grow, investment performance tends to fall away. So there's a very natural conflict between the interests of investors and the interests in the providers of financial services. So keeping this investment principle at the very pinnacle of everything we do, we feel is incredibly important. So being independent-minded, this is really focusing on the fundamentals of investing and not being impacted by short-term sentiment or market noise. And again, I think if you think about the structure of the industry and the large amounts of institutional money that actually are invested these days, there is really a relative performance mindset that dominates institutional investors by and large, and we have a relative performance or a peer relative institutional investment derby, and that really does stand in the way of assessing investments based on their own absolute sort of sense. So keeping a focus on what makes sense in an absolute sense, we feel is far more important than focusing on relative returns. Investing for the long term, Warren Buffett is undoubtedly the best example of long-term investing. If you look at the behavior he's exhibited over the years within Berkshire Hathaway, in many instances when he has acquired companies, he's acquired those companies outright. He's delisted them in many instances, and he never intends to sell them. He's always said that if you can find a great business with great management, his best holding period is in fact forever. So he was really focused on the cash flows that would be generated from those businesses. He was never interested in actually hoping to sell those businesses at a higher price in the future. So keeping a focus on investing for the long term, and you only have to look at the track record that Berkshire Hathaway has to understand the fantastic results that accrue to long-term investors. We're valuation-driven investors. You're going to hear a lot from Daniel on this a little later on. This is really the foundation of everything that we do, being valuation-driven. Benjamin Graham, of course, is the father of value investing, and he distilled this concept very neatly into that concept of prices, which fluctuate very, very widely on a daily basis, and you only have to turn on the television or look at what happened. Markets will report, or the news will report what happened in markets the previous day, the previous week. And you tend to see that prices fluctuate very, very dramatically on a daily basis. And what he really argued was that by looking at the underlying cash flows that actually accrue from companies over a period of time, those earnings or those cash flows are actually far more stable. And by analyzing those cash flows, you could develop an idea about what the intrinsic value of a company actually is, which is a far more stable and objective measure of value. And then, of course, value-driven investing is about how do you put these two together. And it's, of course, very simply looking for periods when the prices of securities are well below the level of their intrinsic value, what he called that margin of safety. And that's really at the heart of what we think about in terms of being valuation-driven. We take a fundamental approach. A fundamental investor is really focused on what is the fundamental reason that I'm buying an asset. And if you are an investor in equities, your fundamental reason for buying an equity is to get the dividends. That's the cash flows that actually accrue to you as an investor from investing in equities. If you're an investor in bonds, it's the coupons that you would earn from those bonds. If you're an investor in property, it's the rental income streams. Keeping focused at all times on those cash flows that accrue and actually to you as an investor and create your wealth, we think is incredibly important. And not just focusing on the prospective price change, the hope of actually selling an asset at a high value in the future. We strive to minimize costs. I think this is pretty self-evident. Investment returns are very uncertain. Investment costs most certainly are not. And these take many different forms. It's not just your explicit fund costs that you might see. It's things like taxes that accrue from high turnover, trading costs, keeping an eye on expenses in whatever form that they may have, and driving costs down enables investors to keep more of their returns. And finally, building portfolios holistically, and this is really the notion that the whole, when we construct a multi-asset portfolio, the whole is really worth more. We want the whole to be worth more than the sum of its parts. And simply diversification, if you think about how you construct a multi-asset portfolio, the simplest way of thinking about that is you start with equities for your return source, and fixed income has typically acted as your diversification or your risk mitigation measure. And the reason for putting those two assets together is really because they behave very differently in different economic environments. They tend to behave quite differently. So they work very, very well, or at least they have until recently. You're going to hear a bit about this from James in a few minutes. But that's the fundamental of constructing a diversified portfolio. And then thinking through very carefully, when you add another asset class into this mix, what is it bringing you that your equities and bonds don't currently have? And we want to be very careful that when we do add additional assets into our portfolios, that we're not just adding more equity exposure or more fixed income exposure. That's why we take customized approaches to many of the assets that we actually add inside these portfolios. And that's something that Andrew's going to touch on a bit later as well. So that's just a very quick recap on our investment principles that really do, as I said in the beginning, set the foundation, if you like, for how we think and behave with our investing. I wanted to just switch now and just talk a little bit about our research resources and the way we access our research across Morningstar. Our investment management team, we have over 100 investment professionals. We're located, obviously within that specialization, if you like, but also, geographically into 3 areas. We have investment hubs in Chicago for the Americas region. We have an investment hub in London for EMEA, and here in Sydney for the Asia Pacific region. We also have a very wide bench of research resources that we access across Morningstar. We have over 200 equity and credit analysts, again, located within that specialization and similarly very geographically spread. We have over 100 manager research analysts similarly within that specialization and located geographically as well. And really what we try and do as we look to build investment solutions based on our proprietary research, we try and tap into these resources as much as we can. We also have a dedicated team of investment, what we've called our investment methodology and research professionals. So these are people, and their job is actually to conduct primary academic research. And I'm going to talk just a little bit about these folks and what they do. So this just shows a timeline, if you like, of the research that we've been conducting over a number of years. So we've been producing academic, and thought leadership research now for over 3 decades. We've got over 250 papers that are published. This is information that is accessible to anybody. So it's on our public website if anybody wants to go and look at these articles. If you're having trouble sleeping, this is your port of call that you want to go to. But it's all there and it's accessible. And in addition to publishing quite widely, we've been very fortunate to be awarded 10 Graham and Dodd Scroll Awards over a number of years. I think having this sort of depth of research inside our business it's a fantastic asset, but academic research is only one aspect of it. And being able to translate this into real-world solutions, we think, is far more important. I wanted to call out just 3 of the things that we've done over a number of years and sort of relate how we actually use these in our methodologies and products today. I'll start in 1977, and that was actually when Roger Ibbotson published a monograph called the SBBI, Stocks, Bonds, Bills and Inflation. And in fact, this was one of the seminal pieces of work that was done to look back historically at the returns from asset classes that came from equities, from bonds, from treasury bills and from inflation. And really what this piece of work did was it looked at returns from those asset classes from 1926 to 76, and then looked at, could you use these returns to forecast what might happen to returns from 1977 through to 2000. It was really one of the first pieces of work that was done to break down the returns from asset classes into their component parts. If you look at inflation, for example, the risk-free rate, and of course the equity risk premium. It's this information that's, you'll still see it today in some of the wall charts that are actually published that show those very long-term returns that actually accrue from asset classes. And it's a very good way of sort of illustrating to your clients, the benefits of long-term investing. In the mid-2000s, 2007, we wrote another CFA monograph called Lifetime Financial Advice, Human Capital, Asset Allocation, and Life Insurance. And this, again, was a relatively groundbreaking and sort of seminal piece of research that was really done into how could you think about an investor's wealth holistically. And that meant not just thinking about their financial capital, but importantly about the human capital that investors actually have. And that's really that notion that a younger investor, when you're younger, you typically have very low financial capital. Your human capital is typically the largest asset you have, which is your ability to derive an earning stream from your employment over your future career. And it was really this methodology that, or thinking about this in the context of a total wealth approach, that actually formed the foundation of the glide paths that we actually use in the construct of target date portfolios or life cycle or life stage portfolios today. So it's that gradual de-risking, of investors' financial capital as they age. And then finally, there's a final piece that's pending publication at the moment, in fact, which is the supply of stock returns, which is actually written by Philip Strahl and Roger Ibbotson. It's actually, as I said, pending publication. And this really looks at, and if you did attend the roadshow last year, you would have heard James talk a little bit about this in the context of how we think about the returns from capital markets. But it looks at the changing behavior of corporates. If you look back through history, corporations have tended to distribute cash flows to shareholders by way of dividends. And that actually started to change a decade or two ago. And now many of them actually do this by way of share buybacks. Instead of distributing capital, they actually buy back shares. And what you tend to find is that many of the models that are actually used to analyze valuation, dividend discount models, actually still are prevalently based on dividends and haven't actually properly incorporated buybacks into them. And that piece really forms, it's the adjustment, if you like, or the methodology for the models that we actually use within our capital markets and asset allocation team. How does that all come together? The way that we've organized the investment management business is through what we call a series of global best practice groups. And that's capital markets and asset allocation. We've got portfolio and risk analytics, portfolio construction in a number of different sort of constructs, if you like. And just to use a practical example, so that methodology or that paper that I referenced that Philip Stroll has written, that forms the backdrop of our capital markets and asset allocation methodology. So that paper has been analysed and worked through by all of our global investment professionals that sit on our capital market and asset allocation team. And really the idea behind that is that we want to have a consistent way of forecasting capital markets. So we have one methodology, one practice, we use that globally, and then within each region, and you'll hear from James in just a minute, the local capital markets and asset allocation team then really make sure that they apply that methodology in a very, very consistent way. And those portfolio construction teams that I referenced, whether they're constructing diversified or real return portfolios, draw on those methodologies together with the equity and fund research resources that I spoke about earlier to construct portfolios for our investors. One of the things that we're trying to focus on is making sure that investors really do understand the suite of multi-asset portfolios that we have. And in many instances, like I suppose many in the market, these just run in a risk profile series, if you like, from lower risk on the left-hand side through to high risk on this side. Whether your business runs using managed funds or separately managed accounts, we offer these suites in both wrappers. And then importantly, I think, as you sort of move up the spectrum, vertically up the chart, you start to get what we call sort of greater latitude of asset allocation. So we start with more risk profile-based aware portfolios, so towards the bottom of the chart, and as we migrate upwards, we use a greater degree of asset allocation flexibility. So a greater focus, if you like, on objective-based returns as you move upwards, on inflation plus-based returns, and then ultimately moving to a new product that we've recently launched, which is an unconstrained multi-asset portfolio. So really the intention here is to make sure that we're being increasingly clear about what each of these portfolios is designed to achieve so that they can be utilised with the business models that you think are most relevant for your investors. I wanted to just finish off just by talking about this area of behavioural science, and it's something you're going to be hearing a lot more from us on as in the years to come. This chart shows you, it's just one fund, it's a single fund that's taken out of our database. It looks at the performance of the fund from 2007 for a 10-year period. So that's the blue line, that's the fund performance. And what you see in the bars, in the green bars and the red bars, is investor behaviour. That's when investors have been investing in this fund or withdrawing their capital from the fund. And what you can see, if you look back to 2007, you can see the fund performing reasonably well, and what has actually happened is investors have invested in this fund quite significantly. So we've seen large amounts of net inflows in those green bars in sort of early 2007. And of course, as we've hit the GFC period and the fund performance has fallen quite significantly, we've seen investors leave this fund and redeem from this fund quite significantly. And really what this just shows you is that while past performance is not a good guide to future performance, it's a very, very good indicator about where investment flows or how investors are likely to react. And the implications of that investor behaviour, of course, if you look at the returns to these investors over this 10-year period, you have a scenario whereby the fund and the reported performance of the fund is 3.9% over that 10-year period. If you actually look at what the average investor has actually earned in that fund, so you're looking at the asset-weighted returns as opposed to the time-weighted returns, the average investor has suffered a a loss of a little over 15%. So there's a very, very significant gap between what the funds are reporting and what the average investor is actually experiencing. And that's predominantly on account of that investor behavior, investing at the wrong time and chasing past performance. So that's a single fund. Russell Kinnell's a director of fund research at Morningstar. He wrote an article called Mind the Gap. He did this in 2013, and this looks not just at a single fund, this looks at every fund in the database. And again, compares the difference between the time-rated returns, which are the returns that funds are reporting, and the actual asset-weighted returns, which is the returns that investors are receiving. So this is every fund in the database, and it shows you the same thing. So this is from his first article. You can see with equity funds, global equity funds, here again, your investor behavior gap, if you like, is a little over 3% for equity funds. And again, for bonds, it's a little over 2%. So, it doesn't matter which funds you're looking at. This is a phenomenon that we see, across all the funds that we actually have. And it's really that investor behavior gap, if you like, that we want to, seek to address. There are definitely better investor outcomes that are available to all investors through focusing on a long-term approach and staying invested. And that's really, some of the behavioural biases that we are seeking to address. Carl Richards is somebody he's a consultant many of you may know. He has a phenomenal way of taking those more complex investment issues, if you like, and distilling them to these very easy to understand graphics that you may find useful to use with your clients. But this is really that difference between the investment return, what funds are reporting, and that difference between what investors are actually receiving is what he calls, and I think what has widely become known as the behaviour gap. And it's really this gap that we would like to seek to address as we create better investment outcomes. And that's really where we would like to work with everyone in the room who might see their role, or part of your role, as being a behavioural coach for investors to help them stay invested for the long term and achieve better investment outcomes. I'm going to leave it there and hand straight back to Peter, I think. But thank you for your time. We look forward to spending the next 3 hours with you.